Welcome back. The market towards close is continuing to maintain that green on the sensex and the nifty, a third of a percent higher. Okay, more like 1/4% higher. But mid caps now flatlining in the red a bit. Advanced declines are at the moment favoring the reds a bit. No, it's green still. Although it's just about 1.02:1. Let's look at some more angles, especially from the F&O space. Let's welcome Rajesh into this conversation. He's CIO at ITI AMC. Rajesh, thank you very much indeed for joining us. I just want to ask you, yesterday all day the conversation was that because the Nifty started the December contract at 23,914, it would end there. It ended way off there. Has that created any reverses for the market, or do you think it's just one of those things that the market can handle that kind of losses?
Well, first of all, I'm not really an F&O specialist. I'm the CIO of ITI.
Sorry, I'm sorry. I think I mistook you for Rajesh Baheti. I'm sorry. Sure. Go ahead, Rajesh. Okay.
Sure. So I would look at, what's going on at this moment in the real short term is probably in absence of players in the market. The real action probably will begin in January of next year. See, let's put this in context as to, what we are looking at. We've had a bit of a slowdown in the economy thanks to the reduction in or absence of government spend, because of which corporate results were impacted. And now the question the market is asking is, when do we see a revival again in government spends? Of course, monsoons have been good. And how soon do we quickly revive or to a greater trajectory, and therefore corporate earnings kind of bounce back? In the midst of this, I think we are seeing some challenges, especially which is coming from the globe. You're seeing what's happening to the rupee, the dollar, the US 10-year treasury, etc., and the implications of that as you move forward. So I think that is really where we are. Those are the questions that the markets are asking. Does the global macro mean that our flexibility to use monetary or fiscal will lessen as you move forward? And does that mean that the slowdown that we are in at this moment will take even longer to revive? And the translation of that for equity markets is, does that mean earnings will be cut again for financial year 26, which means that we could have a lackluster market for some more time to come?
Okay, first, my apologies, Rajesh. Another person with the same name is what I confused you with. I'm really sorry. But yeah, speaking of earnings, the earnings forecast that I have got from for FY26 range between 13% and 17%. That's the bull and the bear case. What's your sense? Is there a downside surprise because of Trump, or is that already built in?
So that's what we are worrying about. I think, even financial year 25 began with I think a 16% kind of a earnings growth expectation. And I think we are ending up with a lower single digit or mid single digit number for financial year 25. And I think, as you move forward, that's the second challenge that we have for financial year 26 as well, which is in case we do not have as much monetary lever or fiscal lever, and Lata, you know this better, given what's happening to the currencies and the interest rates globally, then does it mean that our revival, because really in the GDP component, G was really the one which was driving growth in the economy. And if that is not able to revive adequately, and if even private sector investments, etc., which Siemens told us is taking longer, and if that also waits to see how Trump policies pan out, then it will mean that we will be in a bit of a slowdown for a little longer, which means that translation, financial year 26 earnings could also be cut. So those are the expectations that which we are approaching this market as you move forward.
Okay, all right. Yeah, and I think that is the big worry, whether the slowdown is going to persist and whether those FY26 estimates are going to be revised downwards. Rajesh, hi, good afternoon and season's greetings. I looked at some of the big broker notes, foreign broker notes, and many people are still expecting 12%, double digit to happen. We'll probably end the current year FY25 at 5%, but the street estimates are still ranging 12, 13%, 14% in some cases. Are they too optimistic?
So, Surabhi, that's really the question that we are asking ourselves as well. Having said that, let's put things into context. India is in a multi-year capex-driven cycle, right? So there is a real estate cycle which is really buoyant, and it's a multi-year cycle. We know that. There is a infrastructure-led, central government-led infrastructure investment cycle on roads, railways, etc. Again, defense. All of that is again multi-year. There is a private sector enterprise private sector enterprise-led power sector capex, which is a multi-year. PLI-led manufacturing, so on and so forth. So we are in a multi-year capex-driven cycle. That is for sure, and therefore I think the bull market, so as to say, in India is going to be healthy, and over it will persist for a long period of time. Having said that, I think there are some clouds which have emerged from the global markets, particularly because of the election of Trump and whatever else is going on in the global macro, and that's why the question is being asked that whether that it will mean a temporary cut in earnings or a slowdown in earnings as you move forward into 26. And that is really what we are worrying about. And it does seem at this moment that expectations should be lowered from equities, at least for the next foreseeable future, until greater clarity comes on this macro situation.
Fair point. But the market is not going to allow you to wait for these answers to be revealed. So at the moment, what are your preferences? Would you go with this K-shaped recovery continuing? Are you betting on consumer discretionaries, hotels, airlines? What's your best pocket?
So Latha, that's the beauty of India. I mean, there are just so many themes that are participating, right? So it's, digital commerce companies are still doing extremely well. And they
Yes.
are, they are non-linear in terms of business models, right? Some of the private banks could actually continue to do well, right? Telecom can continue to do well. Pharma can continue to do well. So there are enough pockets which can continue to do well as you move forward. IT could continue to do well, especially if Trump wants the US economy to kind of get stimulated. So there are enough sectors to kind of bet on as you move forward on the positive side. Having said that, I think you could see some disappointment on capital goods. You could see some, dragging of consumer-facing automobile companies, consumption, retailing, oil and gas, which are especially exposed to the global markets, global metals. So there is, I think, unlike the March 23 to September 24, where the entire breadth of the market kind of went up, now you're seeing a more selective pockets of where there is action in terms of positive side and where there is negativity. So the breadth of the market has narrowed since September of 24. But fortunately, there are enough sectors which are still positive as you move forward, and there are enough sectors to kind of view with caution as you move forward.
Okay. No, I take your point. India offers, some options, even in otherwise downbeat sectors. I'm going to ask you about how would you take advantage of the Indian rupee. But before that, let me just wrap up what happened today. It was an extremely zigzag movement in the currency. For the first time after the Trump election, since when we have been seeing a slow depreciation of the rupee, we saw a rapid depreciation. We saw a 50 paise giveaway of the rupee from about 85.27, that was the overnight close, all the way to 85.75. This has not happened in a very, very long time, perhaps not even since 2013 or thereabouts, if I remember right. But the usual reasons are there. Dollar has been strong over the 108.2 mark or 108.1 mark as far as the dollar index is concerned. Importer buying, which is normal towards the month-end, oil importer buying, all that were there. But why was the rupee allowed to depreciate so much? It's quite possible that the Reserve Bank decided to give the rupee an adjustment mode today because of the Reserve Bank bulletin in December indicating that in November, the rupee was 8% overvalued. We always get that data with a month's lag. Perhaps the Reserve Bank smelt that there are speculative forces at work after looking at that number, and they just let them have their play. Why should they get an exit at a higher price? Perhaps that was the reason. But the Reserve Bank was absent for some time. That was one reason why the rupee fell. A second reason why the rupees, people are guessing fell was because the NDF market, the offshore market for the rupee, where the rupee is traded as a derivative, there the Reserve Bank had positions, today's expiry day in that market, and probably some of the positions were shifted onto the local market and settled. And that also put some pressure on the rupee. Be that as it may, the Reserve Bank suddenly made its appearance at 85.7, and then the losses of the currency were cut by half. That's broadly the story today. In spite of this 50 paise fall, the rupee is still an outperformer, and that graph will come up for you. Both November 1st to date and Jan 1st to date. Just look at the data that's come up for you. The rupee is an outperformer. November to now, just 1.49%. And now it will be even less because this was when the rupee was at 85.7. And of course, Jan 1 to now as well at 2.87. It is among the better performers. Now, to you, Rajesh. Rupee fall, does that make anything attractive for you?
You know, the sensitivity of exports to our currency has not been that, favorable. So it's really, we can't find sectors which are directly, beneficial because of the rupee falling. But it does create a headwind. Look, if interest rates in America are going to go up, right? So if 10-year treasury is 4.65, it goes to 5%, right? And so imagine if you're an FI. Now you're getting a 5% yield in the US.
Risk-free return.
Risk-free return. Now, if you come to India, you'll probably have to hedge the currency. Maybe that's a 2.5%, or maybe 3% kind of a cost to you. So your break-even in fixed income guaranteed return is about 8%. Then you want an equity return from an emerging market, which you think is slightly expensive, right? The median PE of India is probably 44. So your expectation there is, not as much, which means that from the demand side of equity, FIIs could continue to remain absent. So I think it does create a bit of a headwind for us in terms of, given how FIIs are a big player in the market. Of course, they've been absent for some time, but they could continue to remain absent. At the best, I hope they don't start selling in a manner as you move forward.
No, fair point. At the moment, it's the US exceptionalism is still playing out because you're gaining both on the currency and on the stocks. And if you're playing fixed income as well, you're in a much better position. But obviously, such exceptionalism cannot go on forever. At some point, the rupee probably at 85.7 is already attractive. We don't know. We will know only when the markets trade in full swing, in full strength after the holiday season is over. Rajesh, thank you very much indeed for joining us. And here's wishing both you and everyone in your team a great 2025.